Hey guys, John Paulamy here, Actionable Intelligence. Today is Saturday, May 9th, 2020. So, the first thing I wanted to talk about was a news item I saw this week, and it was three Democratic senators that were proposing legislation to dramatically expand monetary support during the coronavirus. And the legislation that they are proposing would basically send a monthly check, $2,000 check, to people who make less than $120,000 per year. It would expand that to $4,000 per month to married couples who file taxes jointly and also provide $2,000 for each child up to three. So that's a lot of money. The payments would be retroactive to March and last until 3 months after the Department of Health and Human Services has declared the public health emergency over. So a couple things here. Most people look at this and say, oh, that would never happen. And it probably won't. It probably won't pass in that form. I think there will be some type of additional help coming just because the unemployment rate is just exploding now. But what I think it kind of leads into a couple things I want to talk about and some of the things I have been talking about. This mass shutdown, the basically coming to all stop on the economy, was done very rapidly. It wasn't something that just happened over a period of 6 months or a year where you just have grinding amount of layoffs and defaults and things like that. We just made a unilateral decision as the various world governments to just stop the economy and shelter in place. And so obviously, if there's not business taking place, there's no salaries. We know the story, right? So what I think this does is illustrates a couple things. First of all, this is what's coming down the line. This is what a lot of people want to do regardless of the coronavirus. This is universal basic income. This is MMT. This is, money for nothing, get your chicks for free. This is just what a lot of folks have wanted to do for a while. So the problem is if you start government programs, they usually don't end, right? So, depending who's in the Congress and who's the president, I think will determine, how far down these roads we want to go. And the problem is I go back to, at least to the people that listen to this program, is to ask the question, where does the money come from? People say, well, it's the government. Well, the government's not some just cornucopia or just some entity of its own that just exists like Daddy Warbucks. It just hands out, money. And it's just the real reason he doesn't hand it out is because he's stingy. The government is us, represents us. It doesn't create any resources. It doesn't have any wealth. It just, whatever it takes from people and gives to other people, that's all it's capable of doing. So if you implement something like this, what does that mean? I mean, say you have two kids and your wife works and you work and you make under $120,000. I mean, you can basically get conceivably $8,000 a month. Why would you ever go back to work? Well, let's say, it's short term, John, when they determine that the public health emergency is over. Yeah, but the confidence. See, the problem is people don't seem to understand. When we were flying high, everything's based on confidence, emotion, when I'm talking about the economy now. So it's like, okay, so we start going back to work. Like we open things up here in Texas. That doesn't mean we just go from the reduced rate of economic activity that we institute on ourselves and just right back to normal. Oh yeah, honey, call the travel agent and, don't cancel that cruise. And hey, I'm glad that the dealership's open so we can go over and buy that F-150. I've had people contact me in the last couple days, the last couple weeks, colleagues, former colleagues, friends, they're losing their jobs left and right. These are guys that are like good at their jobs. And some of them are in the oil industry, some of them in the construction industry. These guys are, management personnel, construction managers, project managers. I don't think that they're thinking about, taking the kids to Disney World next month. So what I'm trying to tell you is I don't think the economy is going to come back like people think, and I've said that this V-shaped recovery is not going to happen. We do not know the full extent of the economic devastation that we've inflicted on ourselves. And I think when this history is written here, this is going to change things dramatically in this country. You're not going to come back from this. Like I said before, I made a video maybe a month before the shutdowns where I postulated that we were living in the greatest financial bubble of all time. That bubble has now popped. Yes, the government has, in cahoots with the Federal Reserve, has, attempted to ameliorate as much of the damage as possible by just creating currency units and distributing them. And that, feels good and looks good and maybe is the humane thing to do in the short term, but that has long-term consequences also. That cannot just go on forever. So, maybe this is a political stunt. Maybe these people are so craven and so sociopathic. I don't know if they actually want to help people or if they think this is a good idea, or if it's just they know it won't get passed, but they can get credit for proposing it. Who really knows? What I'm trying to tell you is that there's a growing segment of the population that doesn't have a grasp of economics, that doesn't think of the nation as cohesive, that just thinks as me, give me, and that segment of the population, unfortunately, is going to grow during this economic dislocation. What did I say a depression was in my mind? A depression is when most people's standard of living goes down. So that if populism and people step forward and say, well, we'll give you something for nothing, yeah, people will vote for that. That's because politics is based on emotion. And that's what the economy is really based on too, is confidence in the future and like a pep rally. That's what I said in another video over a year ago. That's what Donald Trump is good at. I mean, he doesn't know anything about economics. He doesn't have any real policies. He runs everything in 15-minute, ahead increments. Whatever, you don't hear him talking about the stock market making new highs anymore. Okay, so he understands the emotion. He understands the vanity. He understands the average person, okay, the everyman, that American. Or as H.L. Mencken said, bubus Americanus. So, wanted to move on, and I'll put a link to this article in the show notes. I mean, like I said, I'm not suggesting this is going to happen. What I'm suggesting is that these ideas move the Overton window. What's the Overton window? It's the subjects that are able to be discussed in normal company. So we're moving more and more to this, free, print, MMT, UBI mentality. And, it's going to happen in some form, shape, or form, in my view. And the repercussions from that are, you can't even speculate at this point. So I want to talk about this Ray Dalio article. I'll put a link to it. It was on LinkedIn. And he talks about, debt. He talks about currency values, relative values between currencies. He talks about the fact various currencies don't exist anymore. Most of them don't. The devaluations that governments and how they devalue their currencies. So, one of the things we talked about why we're in this big financial crisis, not just because we shut the economy down, but also because of the huge levels of debt that we've incurred over the last couple generations. So there are really only 4 ways that you can get debt down relative to income and cash flow so that you can actually service the debt. The first one is austerity, which means you just cut back on all spending and your savings rate goes through the roof. You live on ramen noodles. You don't spend any unnecessary money. But people don't like that. That's not very fun. They tried that in Greece and some other places, and, it did get because the euro, the governments of Greece and, couldn't devalue their currency because they were tied to the euro. So they tried austerity, and that resulted, in several years of above 20% unemployment. So that's not fun, and that's deflationary, and people don't like that, and you can't stay in power if that's what you tried to do. The second thing you can do is you can just default on your debt or restructure. We've seen a lot of countries do that in the past. That's also deflationary. That puts you in a bind as a policymaker on what you can and can't do. So that's not very fun either. You can transfer money and credit from those who have more than they need. I don't really like this, how he wrote this, to those who have less than they need, i.e. raise taxes, well, redistribution, confiscation and redistribution of wealth. Well, that is going to happen. I would suggest to you that we're going to see more populism of both left and right, and we are going to see, I wouldn't be driving around in a Lambo or flaunting my wealth at this point going forward, because we're going to see policies of wealth confiscation, tax raising of taxes, and redistributionary policies. Or the other thing you can do, we are going to do that also. We're going to see defaults and restructurings. We're going to see transfers of, we're going to see taxes go up on the wealthy, or who are perceived as the wealthy, or perceived, as Dalio says, as having more than they need, however that's defined, and then giving to those who have less than they need. Who determines what one needs and who determines who gives what to who is interesting. That's been tried before. We know the results, not pleasant. Or we can do what's the easiest thing to do, and what I suspect will probably be done, is just print money and devalue the value of it. So, and that's what we're doing now. That's basically what we're doing. We're just printing money out of thin air. We're giving it to people. I'm not suggesting we shouldn't do that. It's probably the humane thing to do. But what I'm trying to tell you is there are consequences to doing that. I'm telling you that you can't just create something for nothing and then buy real things that are actually worth something. So if you do that, eventually you're going to have a problem. But that is typically, through history, what most governments choose to do, because in the initial stages of printing money, for a year or so, maybe it'll feel good. You'll see an initial impact to growth, although it won't be real. You'll see nominal growth go up. People will feel wealthier. But then, if you keep doing it, the amount of currency units starts growing faster than the economy's ability to produce goods, and then you start seeing prices go up. So that's a problem. But if you're a debtor, if you're a country that's in a lot of debt and you issue currency units and pay off your debt with currency units that are worth less and less, that can be to your advantage. Although in the end, you're basically confiscating wealth via the printing press. And why do I bring this up? It's going to happen. It's already happening. The special purpose vehicles for buying ETFs go into effect, I think, next week. I think they're going to start actually buying. They've set these things up now. They're going to start buying them. The various, junk bonds and things like that. Those prices have already rallied because all the Wall Street Sharpies have already, the Fed, that's how they do it, right? They tell everybody what they're going to do so everybody can get in first, and then the Fed can come in behind them and the Treasury and buy the assets. So the market kind of stabilized it because it was front running the Fed. So now the Fed has to follow through or there'll be a big sell-off. So again, you have to ask the question, where is the money coming from to buy these $750 billion in junk bonds or whatever they're going to buy? They don't have any money. They didn't raise taxes to pay for it. They've just created it out of thin air. There's a lot of the MMT type people say, well, they twist themselves into logical pretzels about how you can do this. And they acknowledge that it will raise prices, that it could be inflationary. But that the only thing you really have to do then is you just have to raise taxes to pull the money out of the economy. Yeah, right. So I think that they need to understand human action and people's how they react and how they respond to incentives. You know how pulling teeth it is to raise taxes in this country, and they're just going to just do that willy-nilly, like lowering and raising interest rates to modulate the economy, to put a governor on the economy if it gets out of control, if they print too much money. It's ridiculous. It's not going to work. You're going to have a runaway inflation. hyperinflation, which is not going to be fun for anyone. So the thing I'm trying to tell you is that this is a pretty good article. I'll put a link to it. This is where we're heading inevitably, not the next week, not the next month, but this really, for me, solidifies it. I've written articles and I've discussed about the Social Security situation, the Medicare situation. We've seen this last week. Several of the blue states, Illinois being on the forefront, running to the federal government and trying to use this crisis as a cover to get a bailout for their pension, municipal employee pensions, state government worker pensions that are totally blown up. All the promises that were made by politicians to get the support of the unions now has to be paid for, and the states don't have the money. So now they're looking for a bailout. And I think to a certain extent, they probably will get, they will get a certain amount of bailout. I mean, they're just not going to leave people hanging. People vote, right? So I don't know how you can stand there as a legislator now and just vote against these things with the populism that's going to be there, with the suffering, with the media showing every, poor Sally story out there, that's going to be the narrative. And then you compound this with the embedded unfunded liabilities of Medicare and Social Security, which are in the hundreds of trillions of dollars. I mean, I don't see any other outcome except for, a lot of money, a lot of dollars being printed. Now, I think what we're going to see is a big deflationary wave that's already hit and is going to continue to swamp us for a period of time. But then as they ramp up, and people say, well, they won't print that much. They have no choice. That's what they'll do. That's what every government does. In the end, they just destroy their currency. They have no choice. Now, it's not something that will happen in the first week or 6 months or whatever, but it takes time. But that will be the policy going forward. What else are they going to do? We're not going to have a V-shaped recovery. Warren Buffett was interesting. He bought airlines, and then at the Berkshire meeting, he dumped them. And he said, why? He said he just doesn't see that business coming back the way it was. So this, that was the original narrative, right? It'll be okay. We'll be locked up for 2 or 3 weeks, and then we'll turn everything back on, and we'll have a V-shaped recovery. Ain't going to happen. Isn't happening. I don't know what kind of recovery we're going to have. We'll have a bounce off the bottom, wherever that is. We're running almost like, according to the Chicago Fed, we got 30% unemployment rate. Now, a lot of people go, I don't know what's going to happen. I have no idea. We're in uncharted waters here. Never in the history of the world has somebody, this is almost like a meteor hit the earth. We will come back to a certain extent, but I don't know. The bounce back is never back to the old highs, right? And that's what I want to talk about next. Here's a chart, just goes back to the last 2 bubbles. Back in here, 99 was the tech bubble, tech bust. They show it, the Great Recession, GFC in 2008. The red line here is the unemployment rate. Unemployment here showing, from 0 to 16%. And the white line is the S&P 500. You will note that as we had the tech bust, maybe an unemployment increased, the market was down. Maybe the market went down first. It looked, who knows? I'm not saying, what I'm trying to tell you is there's a correlation here. As the unemployment rate goes up and we have a 70% based, consumer-based economy, spending's going to go down. It's just intuitive, right? It should be logical. So here is the unemployment rates. You had some unemployment here. Okay, you went from 4 to 6. Okay, all right, 4 to, 10. Now we've went to, less than 4 to, 15 or 20. Bang, that quick. And the market, dropped originally and then bounced back. But it's just, I think this is just, like I've said before, an echo, a short covering rally, an initial response, and I think we're coming down a lot further than this. To think that, okay, well, now we're going to go on and make new highs. That's what people are actually, some people are actually saying that. Well, they've created so much money, but so much money has been destroyed, so much debt. This deflationary wave is going to come across and just, undermine a lot of things. I mean, people aren't paying their rents. So the people that own the buildings where the renters are they paying their mortgages? And at what point, if they're not paying their mortgages, does the bank have an issue? I mean, all these things cascade through the economy. And no one's thought this stuff out. And it's just happened so quickly that it hasn't had a chance. These reverberations, these ripples haven't made it through. So we felt the full effect. I would suggest to you that the stock market's going to be going a lot lower. So I'd be very cautious about owning stocks, any stocks, because if we get another leg down, if we get a scenario where stocks go down, 50% from here, I don't see many sectors being spared. So you have to, who knows what will happen. I'm just telling you, when you're in a bear market, most stocks go down. Now, there will be pockets of things that go up. Does that mean I'm selling my gold stocks? No. Does that mean I'm selling my uranium stocks? No, I'm not doing that. But what I'm telling you is that this is not good. We don't know the full extent of the damage still. And to suggest that, hey, we're back to normal, that's not going to happen. We've seen this before. The reason I say this is why I wanted to talk about this is, on Twitter, this guy put this up here. He's talking about the Great Depression. It's not like, Hoover sat around before FDR and didn't do anything. When the initial stock market crash happened and the economy started to come unwound, they did stimulus measures. And listen here, what they did. Emergency rate cuts. Hoover proposed reduction in tax rates. Hoover to increase public construction spending. Hoover convened working group and lenders of top 72 tycoons, solicited pledges from business not to cut spending and from labor not to strike. I mean, so it's not like they just sat around and did nothing. And they did get a rally. They got a 6-month rally, and then it fizzled. So what I'm trying to tell you is we've built up so many overvaluations, so much debt, so much leverage, and now we found a pin, the trap door open, and it's very, very difficult to get that confidence back now, to get that consumer sentiment back, for people to say, I'm not scared. People are scared. They don't know what's going to happen. People are getting laid off left and right. They're losing their jobs. I know people. Like, am I next? I'm going to conserve my cash because I may not have a job in 6 months. I'm certainly not going to go, buy a brand new house right now. I don't think most people are thinking that. I don't think most people are thinking, they've seen now 3 times in 20 years. Well, this hasn't fully played out, but at least, these played out how they did, the loss of wealth and people's retirements and their businesses and their futures, and had to reinvent themselves. And now again, when these people are getting ready to retire. I mean, people that were in their 40s here in 2000 that got banged here and here, they're getting ready to retire. And what message does this send to people that are 20 years old? I mean, they grew up during this great financial crisis. Maybe they saw their parents, and now they're experiencing it. So to say that, well, we're just going to bounce back, I think is naive. And like I said, we've seen this before. It's false hope, bull trap, I called it last week, I believe. We were getting sucked in to a bullish thesis that doesn't make any sense. Wanted to point out the Fed balance sheet continues to grow. We're now up to $6.7 trillion. It's kind of slowed down from the rocket ship it was on originally. But I think this is going a lot higher. Where it stops, I don't know. They keep proposing more programs. I think the damage is going to be unbelievable, and they're just going to keep doing what they need to do. That's what politicians do, right? They have to do something. I have to be seen as doing something. The people are clamoring for somebody do something. So that's what they're going to do. Whether the policies work, I don't know. Probably not. But they're going to do something. And they're just going to create, if they need money, they'll just create it out of thin air. That cannot be good long term for most people. I did want to point this out. I've pointed it out before. This is the S&P commodity index against the S&P 500. Again, we've had commodities in this massive bear market for over 10 years. Well, I guess you could say the top was in 2008. And then since 2008, at least a decade, right, going on 12 years. But are we starting to see, do we see a bottom, and are we starting to see some signs of life? And what I would like to point out is people say, well, it sounds kind of strange, or kind of your message is mixed. You're talking about a deflationary wave, but yet you're talking about the possibility of commodity prices going up. Yes, because I'm talking about supply destruction. If the supply of a commodity is destroyed faster than the demand is destroyed, then the price will go up. So I think it's fully possible as companies go bankrupt, as various countries go bankrupt. We don't know. Like I said, all this has now been thrown into a big pot like a stew and just turned the heat on. We don't know what kind of soup we're going to get out of this now. And so what I would suggest to you, though, is that I don't think U.S. stocks are going to be doing well over the next 10 years. And with all the money printing that I'm anticipating, infrastructure spending, all these programs that are coming down the line, I mean, it's going to make what FDR did look, like a kindergarten game. Now, it's not going to happen in the next 3 months, but I'm saying, if I had to pick being long U.S. equities over the next 10 years, just on the S&P index or just commodities, a basket of commodities, I'd take the basket of commodities. A guy emailed me. I saw this chart. A couple people have emailed me. Wow, the uranium stocks have really moved. Should I sell? Probably not. I mean, this is a chart of Cameco for the last 20 years. Here was the peak back in its price in 2008. It was up around $40 a share. Looks like it might have broken out of this long-term downtrend. Yeah, I would say if you think that uranium prices are going higher, which I believe they are, yeah, I don't think you should sell yet. You're way down here. You got a long way to go. And like I said, this is multi-year, guys. Even during this run, look, it started launching in, mid-2002, 2003. You could have bought Cameco all you wanted for about $4, $3 or $4 a share. And it took, 1, 2, 3, 4, 5, 6 years to top out later. You had 10 times your money in basically 4 years, 5 years. So, no, I don't think you should sell. You should be a long-term investor. You should add on weakness. Uranium's in a bull market. They're not going to stop building nuclear power plants even if there's a depression. Last but not least, just wanted to point this news out. I'm not really, like I said, going to deep dive every bit of news, but I thought this was interesting. KazAtomProm maintains their COVID-19 shutdown. The company in April announced measures to reduce the risk of COVID-19 spreading to its in situ recovery operations, resulting in a lower level of wellfield development activity and thus lower production volumes. It has revised its 2020 guidance and now expects to produce 19,000 to 19,500 tons of uranium, down from the previous 22,750 to 22,800. So, long story short, I mean, if you look at like how many cases of COVID-19 were in Kazakhstan, what Cameco's talking about in their minds are shut them down. Yeah, they want to protect the people, the miners and stuff, but this was, to my mind, a cover story to help dry up the inventory, to help market sentiment become more bullish, to force some action, I believe, it's not nefarious. I mean, they can do whatever they want, but it gives them better cover story than just to come out and say, hey, we're going to be out here pushing the price up and we're just going to keep these mines shut. And you can just say, well, we're protecting our workers and COVID-19, blah, 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 and, squeeze the market even more. So that's my view, at least. So that's it for this week, guys. Appreciate the support. Channel continues to grow. If you're interested in how I take the things that we talk about in these videos and transform them into actionable investment themes, please take a look at possibly taking a subscription to the Actionable Intelligence Alert newsletter. $79 a year. We think we have some good ideas in there. It's a monthly newsletter that comes out to your email, and there'll be a link in the show notes if you are so interested. We also have a sampling program. You can go to our Patreon page, which I also put a link to, and if you contribute $5 a month, you can cancel that at any time. I will send you the current month's or the most current recommendation we've made in the newsletter for your perusal, and that way you can determine whether or not the Actionable Intelligence Alert newsletter fits your thinking and your needs. So that's it for this week, guys. Appreciate it. We'll talk to you next week.